Welcome back to The Explainer. Today, May 5th, 2026, the SEC just dropped a major proposal that could totally shake up how public companies report their financials. If you've got money in the market, whether you're actively trading or just peeking at your 401k every now and then, the info you rely on to understand the health of those investments is dictated by the SEC. And well, they've just pitched an idea that might completely alter the rhythm of the entire financial world.
It really boils down to one massive question. What if companies only reported twice a year? That is the absolute heart of this new proposal. We are looking at a potential shift away from the decades-old expectation that investors just have to receive detailed financial updates every 3 months. Now, I know it sounds like a simple scheduling tweak on the surface, but as we unpack the details, you're going to see exactly why this is sparking some intense debates from Wall Street all the way to Main Street.
So here's our agenda for today. We're going to cover 1, the current quarterly system, 2, the proposed semi-annual shift, 3, the benefits of less reporting, 4, the risks to market transparency, and finally, 5, the impact on individual investors. Let's dive right in.
Starting off with Section 1, the current quarterly system, or the 10Q status quo. To really grasp the magnitude of this proposal, we first need to quickly ground ourselves in how financial reporting actually works today.
Right now, public companies in the U.S. have to file what's called a Form 10Q. This ensures that investors get 3 quarterly reports every single year, plus 1 massive annual report. And these filings are dense. They lay out everything from raw revenue and profit numbers to emerging business risks and overall performance metrics. This 3-month rhythm has literally been the heartbeat of the markets for decades, designed entirely around strict transparency and accountability. You always know, for sure, that you are never more than 90 days away from a deep dive into a company's books.
But think about it like this. Checking your portfolio quarterly is a lot like stepping on the bathroom scale every single week, whereas semi-annual reporting is more like checking your overall fitness progress every 6 months, right? When you check the scale every week, you see these minor, day-to-day fluctuations. Maybe you're holding water weight or you had a heavy meal, and that can cause some serious short-term panic. But checking every 6 months? That reveals the true long-term trend of your actual fitness, even if it smooths over those immediate short-term missteps. That psychological shift is exactly what the SEC is trying to address for corporate executives and investors alike.
Which brings us to Section 2, the proposed semi-annual shift and the introduction of Form 10S. The mechanics of this proposed paradigm shift are actually surprisingly simple. Instead of 3 10Qs, companies could opt to swap those out for a single 10S, filed right at the halfway point of the year alongside their usual annual report. So fewer updates, but much broader ones. Now, the absolute key word here is optional. The SEC isn't forcing anyone to ditch quarterly reports. They are just offering the flexibility to choose a twice-a-year schedule if a company feels it better suits their business model. And for the companies that do decide to opt in, we're looking at a 40 to 45-day window. Under the new proposal, this optional Form 10S would generally be due 40 to 45 days after the first 6 months of the fiscal year wrap up, depending on the company's specific filer status. So it gives them a solid chunk of time to compile a much wider 6-month view of their operations.
Moving into Section 3, the benefits of less reporting. You're probably wondering, why exactly would the SEC want to reduce the frequency of information? Let's look at the driving philosophy here. We can look directly at the words of SEC Chairman Paul S. Adkins. He stated, "The rigidity of the SEC's rules has prevented companies and their investors from determining for themselves the interim reporting frequency that best serves their business needs and investors." That really hits the nail on the head. The SEC believes the current system is basically a one-size-fits-all straitjacket, and that a little more regulatory flexibility is absolutely required.
When we break down the SEC's core objectives, it boils down to 4 main pillars. First up, reducing the sheer burden, time, and compliance costs associated with filing full financial reports 4 times a year. Second, and this is a big one, relieving that intense pressure on CEOs to meet arbitrary 3-month earnings expectations. Third, by doing that, they are hoping to encourage companies to focus on long-term strategy and sustainable growth instead of just scrambling to pump up the numbers for the next quarter. And finally, by easing up on the regulatory demands, they want to make public markets way more attractive, actually encouraging more private companies to go public.
But of course, there's another side to this. Let's neutrally examine Section 4, risks to market transparency and the criticisms, because, as you can probably guess, not everyone agrees with this change.
The core concern from critics is exactly what you might expect: reduced market transparency and much longer gaps between detailed reports. Critics are raising a massive red flag about the potential loss of visibility into a company's financial health. I mean, when you go from a 3-month check-in to a 6-month check-in, a whole lot can happen in the dark.
Let's break down the specific market risks analysts are warning us about. Obviously, less frequent information means greater overall market uncertainty, but it's that third bullet point that is absolutely critical, a possible increase in information imbalance. Think about it. If corporate insiders know a product is totally failing in month 4, but the public won't see the financials until month 7, that creates a dangerously uneven playing field. Analysts warn this could lead to mispriced stocks and seriously volatile, delayed market reactions once the curtain is finally pulled back.
Now, it is really important to point out what is not changing here. Even if a company adopts semi-annual reporting, they are still legally bound to file a Form 8K. The 8K is that mandatory SEC filing used to immediately alert investors of any major sudden developments. Think a sudden merger, a CEO abruptly quitting, or a massive financial shock. So investors wouldn't be totally flying blind to catastrophic events. It's really the day-to-day financial drift that would be hidden from view.
So, let's bring this all together with Section 5, the impact on individual investors. What does a shift to Form 10S actually mean for you, the retail investor, monitoring a 401k or personal brokerage account?
Tracking your performance under this new system comes with some distinct trade-offs, as you can see here. On the portfolio tracking side, the benefit is you might feel a lot less short-term panic when a stock dips on a mediocre quarter, but the risk is your own slower reaction time if the company is actually going downhill. When it comes to company focus, you might benefit from leadership steering the ship toward long-term growth, but you have to accept the risk of having way less frequent data to verify they're actually on course. Ultimately, it really comes down to a balancing act, weighing the peace of mind of long-term horizons against the risk of reduced overall transparency.
Which leaves us with this final, profound question. Should markets focus on short-term performance or long-term value? As the 60-day public comment period on this SEC proposal kicks off, it really asks us how we define success in the financial world. Are we better off demanding constant proof of profitability every 90 days, or should we give companies the breathing room to build over seasons rather than quarters? It's a massive philosophical shift, and the outcome is going to shape how we invest for decades to come. Thanks for hanging out with me for this explainer. I highly encourage you to read up on the proposal and keep learning.